Hey, how's it going, guys? Welcome back to another weekly market update. We had some sell-off going on this week. A lot of people are getting panicked and wondering if this week's sell-off could be the beginning of another big crash. With this sell-off, should we be greedy and buy, or should we be fearful and sell? In this video, I will go through both technical and fundamental analysis, take a deeper look into this week's sell-off, and answer this question for you guys. Also, I will share with you guys how you can navigate the US equity market for the next 3 to 6 months in such extraordinary economic environment. Please make sure you watch the video until the end and don't miss out anything because I will cover a lot of important insights. I promise you guys I will make it quick and don't waste your time. Alright, let's get started. Last week, we were up 5%, and this week, we're down almost 5%. A lot of investors were panicking right now, wondering if this is the beginning of another major downturn. Let's take a closer look at this week's sell-off from some technical analysis first. If we apply the Keltner channel indicator on the S&P daily chart, we can easily see that since last week, S&P has been in the overbought territory for 6 trading days in a row. That is a very unusual strong rally. So a minor pullback should be expected. And that is exactly what happened on Thursday and Friday. We had a sell-off that drags the price back to the 20-day moving average. Also, if we add a 50-day moving average and a 200-day moving average, we can see that the 50-day moving average just crossed and stayed above the 200-day moving average. That is a very old-school classic bullish sign called a golden cross. And when that happens, usually we should expect the price to have a pullback. Plus, the volume is lower than last week's rally. So from the technical analysis, the sell-off this week is nothing more than a reversion to the mean. It's still too early to say if this is a sign of another big crash, but for now, it looks more like a normal reversion to the mean pullback after a big rally. Alright, from the fundamental perspective, there are 3 main reasons that caused a sell-off this week. First, it's because of the Fed meeting on Wednesday. Investors were a little bit disappointed over the lack of confidence from Jerome Powell, and also the Federal Reserve wasn't dovish enough. So that caused a small panic in the market right after the meeting. That was what we saw on Thursday. Second, it was because of the bad news on COVID-19 new cases that are coming back all over the US, especially those states that have reopened. Third, it was simply because some of the investors were taking profits after this crazy V-shaped rally. If we take a look at the bond market, the 2-year yield still remains the upper side of this range. The probability of breaking out from the upper side and going up still remains high. And that is a sign the stock market rally is still stays strong. One of the easiest ways to know if the stock market is about to crash is to look at the bond market. It usually leads before the stock market. For example, in 2020, the stock market started crashing on the 20th of February. But the bond yield has already started crashing since mid-January. So for now, based on the bond market, it shows that we're still not quite ready for another big crash yet. Dollar still remains weak, but we do have a V-shaped bounce on the dollar. We need to keep our eyes on the dollar next week and see how it plays out. Because if this V-shaped bounce on the dollar continues with a strong rally and it breaks the important market structure, then it will add some pressure on the stocks to go to the downside. To navigate the US equity market in the short term and determine if it will go up or go down in the next 3 to 6 months, we just need to answer one question. What are the things the current market has already priced in? The closer we can get to answer of this question, the easier it will be for us to see where the market will go next in the short term. In my opinion, there are 4 major factors the current stock market has already priced in. Just a quick disclaimer here before we move on. This is a financial education channel, not a channel to discuss politics. I'm not interested in debating who should be the next president. Anything I say on this channel only represents my financial views, not my political views. Alright, the first and the most important thing the market has already priced in is that we will most likely have the second wave of coronavirus, but it will not be as bad as the one in March, and there will be no more global lockdown. So what does it mean? It means the cases and the death count will probably be an ongoing event in the US throughout the rest of the year. It is not going to go away anytime soon. The market knows it and already bakes this fact into the price. But what the market hasn't priced in is that if we have a bigger second wave, the case count suddenly jumps even worse than the March and the entire US goes back to lockdown again, then the market will react very negatively to the downside. The COVID-19 recovery is very connected with the economic recovery too. For example, this is the current S&P 500 quarterly earning estimates from major investment bank analysts. As we can see, the current market believes that in the next 2 quarters, we will have a big earning recovery from the second quarter low, and that is hugely dependent on a smooth reopening with no more lockdowns. So the current market price is telling us that the investors are very confident the worst is already behind us. The second factor the market has already priced in is that the Republicans will beat the Democrats in November and Donald Trump will continue to stay in the White House. Why is it so important? No matter how controversial Donald Trump is as a president, there is one thing we cannot deny as investors is that his controversial policies are extremely beneficial for the financial market, especially the stock market. In 2017, he cut the corporate tax from 35% to 21%. This one single policy alone completely bent the entire economic earning growth trajectory back to the uptrend. Also, he's a big fan of a low interest rate with massive money printing. Even though all these policies are very short-term driven and they are gonna hurt the US economy a lot in the long term, which I will talk about it in the next week. But for now, investors do love Trump's policy for their own money. On the other hand, if Joe Biden becomes the next president, he will significantly increase the taxes, especially the corporate tax and the wealth tax. Also, the Democrats are not a big fan of big monopoly companies like Facebook and Amazon, and also they don't like cheap capitals with zero interest rate. So it's safe to say the current market has priced in the fact that the Donald Trump would beat Joe Biden in the election and continue being the next president. If there's any sign showing Joe Biden will win the election, then the market will start crashing to the downside. Again, I'm not here trying to debate who is a better president. I'm just trying to purely focus on the finance and show you guys the financial facts. And the third factor the market has already priced in is the fact that the Federal Reserve will continue being extremely dovish and keeping their unlimited support on the market. Guys, this is huge. A lot of people, including myself, have been really surprised by how crazy this V-shaped recovery is and how the stock market completely moves away from the fundamental economic reality. If you want to know why, this is exactly why. On extremely dovish Fed plus unlimited QE. Even though I'm short-term bullish on the US stock market, I'm not a big fan of how the market moves recently. This current market is extremely addicted to the Federal Reserve fiscal policies. In other words, this current market is purely inflated with the hope that the Mama Fed will print unlimited helicopter money and feed everybody. This is an addiction, guys. The market has been pricing in this addiction of Fed's unlimited helicopter money for the past 2 months, and we all know what it means to be addicted to something. If there's any signal showing that the Federal Reserve will start restricting the money supply, taking this addiction away from the investors, even though just a little bit, the market will immediately start its next big sell-off again. And then the last one important thing the market has already priced in is that the tension between US and China will remain the same. This is the factor a lot of investors don't really pay attention to, especially with the ongoing domestic problems like lockdowns and the protests. However, these factors will carry more and more weight to the stock market when the election comes closer, as both of the Democrats and the Republicans have to draft a series of policies on how to deal with China's rising power. The current market has priced in that China will not significantly escalate the current tension with the US, and the trade war will continue to phase 2 as expected. However, if China and the US choose to suddenly escalate the tension between these two superpowers, it's gonna hurt the market big time. We have seen that in 2018. Alright, here you have it. The 4 major short-term factors that have been priced in and reflected by the current market. So, your personal view on how these 4 major factors are gonna play out in the next 3 to 6 months will determine how bullish or how bearish you are on the market for the short term. For example, my personal view is that although the second wave of the coronavirus is almost inevitable, I highly doubt the US will enter another major lockdown. The worst is probably behind us, especially according to the jobs report. The current president is holding a higher chance to be re-elected, and he will keep adding pressure on the Federal Reserve to make sure there is enough money to boost the market. China is hurt by the coronavirus a lot as well, so I highly doubt they currently have any leverage to escalate against the US at this moment before the election. So for the short term, these 4 major factors will most likely drive the market up. I'll definitely keep following all these signals and keep you guys updated if there are any major changes coming up. Again, these are only short-term driven factors. For the long term, it's gonna be a whole different picture. In the next weekly market update, I will share with you guys how to navigate the US equity market for the long term, and what are the things you should be looking at if you're a long-term investor. Alright, this will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business and find my videos and be valuable to you, please consider subscribing. Thanks so much for watching, guys, and I will see you guys soon.